Over the past decade, I generated just over 20% annualized returns, which is more than 5% per year ahead of the S&P 500. Put another way, an investor who simply bought and held the S&P 500 over that same period built wealth. I built roughly 60% more of it. And I want to be completely clear about two things before we go any further. First, this is not luck. I am a CFA charter holder, the highest level of investment education available, and I was one of roughly 8% of candidates who passed all three levels on the first attempt. Second, and more importantly, the story I am about to tell you is not just a highlight reel. Some of the most valuable parts of this video are the failures. The decisions that cost me real money, and the lessons I extracted from them that fundamentally changed how I manage my portfolio today. If you are only interested in hearing about what went right, this is not the video for you. But if you want an honest, professional-level account of what it actually looks like to beat the market over a decade, including the periods where it was genuinely painful, stay with me because there is a lot here that could change how you think about your own investments. Let me give you a sense of who I was when this period started in 2016 so you understand the context for the decisions I made. I had just finished earning my CFA designation, which took me 3 years. I was not a beginner. I had learned how to analyze companies, value assets, understand market cycles, and build portfolios at an institutional level. And my investment philosophy was already well established. I am a deep value investor. I like to buy things that everyone else is selling because of short-term fears, when I have strong conviction that the underlying reality is better than what the market currently believes. It is essentially what Warren Buffett described as being fearful when others are greedy, and greedy when others are fearful. That sounds simple. In practice, it requires a specific kind of psychological makeup, the ability to hold a position while the market screams at you that you are wrong, and I had spent years developing that. That context matters because 2016 was the perfect environment for exactly that approach. The year started with the worst opening to a calendar year in stock market history. The reason was fear about China. Starting in mid-2015, Chinese stocks collapsed after a 15-year run of extraordinary performance. The world feared what economists called a hard landing, a severe slowdown in the Chinese economy. And since China had been the global growth engine for a decade and a half, those fears spread. Multinational companies, commodity producers, emerging market economies, all of it got hit. And in the middle of that fear-driven sell-off, I was looking for specific places to buy. The one I found was Vale, a Brazilian iron ore producer whose largest customer is China. If Chinese housing slows, iron ore demand collapses, which is what happened. Vale's stock had fallen more than 90% from its 2011 peak. I was not predicting that China's economy would be fine in the short term. I was making a simpler bet. The fear of a Chinese hard landing was priced in at a level that did not reflect the more moderate outcome I thought was actually likely. I built the position in stages, an initial purchase in June 2015, then doubled it in August, doubled it again in November. I did the fundamental analysis, confirmed the company was not going to go bankrupt, and let the thesis play out. When I sold in March 2017, the net gain was approximately 66%. That is the kind of asymmetric opportunity I look for. Extreme fear, a thesis that the worst-case scenario is not the base case, and a company strong enough to survive while the market comes around. I want to acknowledge two things about that Vale trade. It worked, and I would not do it again. Not because it failed, but because I no longer buy individual stocks. Once you truly understand what it takes to properly analyze a company, the financial statements, the competitive positioning, the management quality, the industry dynamics, the macroeconomic exposures, you realize how much time it genuinely requires. Most professional fund managers who do this full-time still do not consistently beat the market. So if this is not your full-time job, you need to be extremely honest with yourself about whether you can actually do the work required to have a real edge. I cannot do that work the way it deserves to be done alongside everything else in my life. So I stopped buying individual stocks. That decision alone has simplified my life and protected me from categories of risk I no longer need to take. But the more significant contributor to my 2016 returns was not Vale. It was something that I want to spend serious time explaining because it is both the single most successful investment I have made over the decade and simultaneously one of the most dangerous and misunderstood strategies available to retail investors. I am talking about inverse VIX ETFs, and before I tell you what they are and how I trade them, I want to be unambiguous. These are not appropriate for most investors, and if you walk away from this video thinking the lesson is simply to go buy SVIX, you have missed the point entirely. The lesson is about a framework for identifying structural edges in the market, and this is one of the clearest structural edges I have ever found. Start with the VIX itself. The VIX is commonly called the fear index, and while that is a reasonable shorthand, it is more precisely a measure of expected downside volatility in the S&P 500 derived from the ratio of put options to call options on the index. When more people are buying puts, bets that the market will fall, the VIX rises. It tends to spend most of its time in the 12 to 20 range during calm markets, but it can spike dramatically and rapidly during periods of genuine market stress. The financial crisis, the COVID crash, the 2015 China fears, all produce sharp VIX spikes. The VIX is not directly purchasable. You get exposure through VIX futures contracts, agreements to transact at a specific VIX level at a future date. And here is the structural feature that creates the opportunity I have spent more than a decade exploiting. VIX futures are almost always in contango. That means the further out contracts are priced higher than the near-term contracts, because investors are always willing to pay a premium for protection against future market events. Think of it as an insurance market. People pay up for disaster insurance even though disasters are relatively rare. Most of the time, that insurance expires worthless. Long VIX ETFs like VIXY buy VIX futures to maintain a constant 1-month average maturity. Because the futures curve is almost always upward sloping, maintaining that maturity requires the fund to constantly sell cheaper near-term contracts and buy more expensive longer-term ones. Sell low, buy high, every single day. The mechanical result is that long VIX ETFs slowly bleed value over time in calm markets. Over the past decade, a fund like VIXY has lost approximately 99% of its value, even though there were multiple periods where it spiked 80% or more in a short window. If you held it through both the spikes and the bleeds, you lost almost everything. Now invert that entire dynamic. An inverse VIX ETF, like FOTTINF, which no longer exists, or SVIX today, shorts those same VIX futures. Instead of selling cheap and buying expensive every day, the mechanics work in reverse. The fund sells expensive near-term contracts and buys cheaper longer-term ones, effectively harvesting that contango premium on a rolling basis. In calm markets, this generates approximately 2.5 to 5% per month in what is called roll yield. Annualized in a calm market environment, this is an extraordinary return. In 2016, FOTTINF at times was over 50% of my portfolio. That concentration is the second thing I would not do again. More on that shortly. I loaded up when the VIX spiked during the China-driven sell-off in late 2015 and early 2016, held through the volatility, and sold progressively as the VIX came back down. I made a significant return. Then I watched it triple further after I sold. That was painful, but I sold for a specific reason. The VIX had declined to around 10, and when an inverse VIX position starts approaching a VIX that low, the asymmetry of risk becomes extremely unfavorable. If the VIX merely doubles from 10 to 20, which is not even a particularly elevated level historically, then standardnam inaboy adverb then inverse adadwain IVX ETF with full leverage would lose close to 100%. My rule, which I have refined over more than a decade of trading this strategy, I buy when the VIX spikes to at least 20, add more as it spikes higher, and sell when it comes back down to 12. That is not a guarantee. It is a discipline that has kept me from being wiped out across multiple market cycles. In over a decade of trading inverse VIX products, I have not suffered a catastrophic loss. I have taken hits, I have had painful drawdowns, but I am still here and still profitable on this strategy overall, which puts me in a very small minority of people who have tried it. Not everything from 2016 carried into 2017 and 2018 with the same success. This is where the lesson I promised about painful periods starts. After a stunning January 2017, up 17% in a single month, I was essentially flat for the rest of the year. I was positioned defensively, convinced that markets were expensive, holding cash, some individual stock positions, a gold ETF, and a short high-yield bond ETF called SJB. The thesis behind SJB was intellectually sound. High-yield bonds are highly correlated with equities. High-yield spreads were unusually tight, meaning you were not being compensated much to take on the risk, and in a market downturn, spreads typically widen and high-yield bonds fall. I was essentially buying cheap protection against an equity correction through the fixed income market. The problem was not the thesis, the problem was my execution and my discipline, or rather my total lack of it. I bought SJB early in 2017 when it looked attractive, bought more on weakness later that year, had two separate opportunities to sell at a profit, and took neither of them. The position dragged on well into 2019 before I eventually exited at a loss. I still have no fully satisfying explanation for why I let both exit opportunities pass. It is honestly the kind of trading mistake I would consider completely unacceptable by the standards I hold myself to today. The lesson I took from it: if you are going to own anything that is structurally designed to go down over time, inverse funds, short positions, anything with time decay, you need an explicit plan before you buy it. Define the event you are waiting for, define your exit conditions, define what you will do if it goes against you. If you cannot clearly articulate all of that before the trade, the bar for entering is too low. 2019 was a significant strategic evolution. I replaced SJB with a much better instrument for expressing the same view, TMF, a 3x leveraged 20-plus year Treasury ETF. Both SJB and TMF should theoretically perform well in an equity market downturn, but the comparison between them reveals something important. SJB bets against high-risk bonds. TMF bets on the safest bonds in the world. In a typical recession or risk-off environment, both riskier and safer bonds react. Risky bonds sell off while safe bonds rally, as investors seek shelter. That flight to quality means TMF benefits from the exact same macro environment that SJB was designed to benefit from. But TMF has one enormous structural advantage: long-term treasuries go up over time rather than down. You do not need to time the trade as precisely. You can hold TMF through periods when your recession thesis is not yet playing out and the underlying asset continues to generate returns. SJB decays while you wait. TMF compounds while you wait. The one scenario where SJB would outperform TMF is a rate-driven equity downturn, the situation where rising inflation and interest rates simultaneously crush equities and long-term bonds. That is exactly what happened in 2022, and I was not in TMF when it did. But in the base case, the comparison is straightforward. Same directional exposure, much better long-term carry characteristics. I started building my TMF position in February, May, and December 2019. At the beginning of 2020, heading into what turned out to be the COVID crash, TMF was over 30% of my portfolio, and SJB plus municipal bonds plus cash accounted for approximately another 50%. When the market sold off in March 2020, I sold TMF progressively from March through July at an average gain of approximately 89%. That was the payoff I had been positioning for across an 18-month window. Now let me walk you through 2020 as a whole, because it was my most dynamic year. It contains my best timing decision and also the beginning of what became my worst investment mistake of the decade. When the COVID crash accelerated in late February and early March, I began buying inverse VIX ETFs, specifically SVXY, which by then was the best available version since the original 13 had blown up in 2018. I bought on February 24th, 25th, 27th, March 5th, and March 12th. I was clearly early. COVID turned out to be dramatically worse than I and most people anticipated, but the strategy I deployed was specifically designed for situations like that. I never committed the full position up front. I started small and systematically added as the market fell further, scaling in as the opportunity became more asymmetric rather than abandoning the thesis when it went against me in the short term. That disciplined approach, buying less than you are willing to risk at the outset, so you have capital to add on additional weakness, is one of the most important habits I have developed over this decade. It forces patience when the market rewards impatience, and it means your average cost improves as conditions deteriorate. Through late March and into April, I began rotating aggressively into leveraged long ETFs across multiple markets. A 3x S&P 500 ETF on March 23rd, which, I will not pretend otherwise, happened to be the exact market bottom. A tiny position, unfortunately, but I am proud of it. A 2x Brazil ETF in April. Emerging markets. A 2x energy ETF in May when oil had just been negative for the first time in history. A 3x Mexico ETF. More S&P 500 exposure. A 2x India ETF. Leveraged recovery plays across the board, systematically building as the recovery thesis gained confirmation. The second half of 2020 and the first half of 2021 were exceptional. And then came the mistake I am most honest about, because it was the most expensive. In June 2020, I started building a significant position in TNA, a 3x leveraged small cap ETF. The thesis was clear and well reasoned. Small cap companies tend to be more economically sensitive than large caps, falling harder in downturns and recovering faster in expansions. With the recovery clearly underway, small caps had significant upside relative to their post-crash lows. TNA tripled by February 2021. The vaccine announcement supercharged the recovery thesis. And then I committed what I consider the cardinal error of my decade of investing. I never sold. The thesis was playing out perfectly. The economy was recovering. Small caps were benefiting. And I let that confirmation of my thesis crowd out everything else I should have been seeing. Valuations in small caps had become stretched by early 2021. Rising inflation and interest rates, the macroeconomic variables that would prove most damaging to small-cap growth companies in 2022, were beginning to show up in the data. My initial thesis had a natural conclusion and I refused to recognize it. By late March 2021, TNA had grown to over 30% of my portfolio, and I had not sold a share. The combination of rising rates, persistent inflation, and the simple reality that my thesis had been fully reflected in the price, turned that position from a spectacular winner into a major drag on my portfolio through 2021 and 2022. I eventually did sell portions at various points through 2023, but never close to the highs. I want to give you the 3 specific changes I made to my investment process after that mistake, because any one of them would likely have changed the outcome significantly. The first is a hard 25% cap on any single position in my portfolio. If a position grows beyond that threshold due to appreciation, I sell enough to bring it back below the cap. That discipline would have forced me to sell TNA near its peak simply because it had grown too large, taking the emotional question of timing off the table entirely. The second is more systematic attention to valuations throughout the holding period, not just at entry. I was always valuation conscious when entering a position. What the TNA experience taught me is that I needed to be equally disciplined about reassessing valuation as a position matured. The same thesis that justified buying at distressed valuations does not justify holding at peak valuations. The third is using RSI, the Relative Strength Index, as a supplementary signal alongside fundamental analysis. RSI does not drive my decisions, but when a position shows extreme RSI readings in either direction, it tells me that the market sentiment toward that investment has reached an extreme. What RSI would have told me in early 2021 was that my optimism about small caps had been fully priced in by the market. My differentiated view was no longer differentiated. And when everyone agrees with your thesis, the thesis is no longer a source of alpha. It is already in the price. I want to move through the recovery phase, 2022 through 2025, because it illustrates something important about how the framework I have built actually works in practice across a full cycle. Coming out of the TNA losses, I had to find the next set of asymmetric opportunities. In 2022, with almost everything in equity markets falling due to rate hikes, I bought energy through leveraged ETFs, UCO for crude oil and ERX for energy companies, which rallied sharply against the headwind that was destroying most portfolios. I also established a position in DFN, a 3x aerospace and defense ETF, in November 2021. I did not know Russia was about to invade Ukraine. I did not need to. Defense sector companies had been selling off on short-term fears. Valuations were depressed relative to history, and the long-term demand thesis for aerospace and defense was intact regardless of what the market was thinking about in the short term. I added to the position in May and September of 2022 and sold in December 2023 at a 57% gain. That is how deep value investing is supposed to work. Find the beaten-up sector, understand why the market is fearful, assess whether the long-term picture justifies the distressed price, and wait with conviction while the market comes to the same conclusion. SVXY, my inverse VIX position, was also a major contributor to the 2023 recovery. I had held portions of it through the 2022 weakness, and, when the VX began declining as markets stabilized, the roll yield compounding kicked in, and I eventually trimmed positions at an average gain of approximately 169% from my 2020 entry prices. The mechanics I described earlier, the persistent contango in VIX futures harvested over years of patient holding, delivered exactly the return profile I had expected, and in 2023 the DPST trade, a 3x leveraged regional bank ETF purchased after Silicon Valley Bank collapsed and the market feared another 2008, is a clean example of how I try to share these opportunities in real time rather than just discussing them after the fact. The fear of systemic banking failure was significant in creating an investment opportunity that I thought was far better than the fear-driven price suggested. I walked viewers through the thesis, explained my position sizing, and sold at over 50% gain. In late 2024, there was one more worth mentioning, a 3x leveraged Korea ETF purchased at the end of the year when the memory semiconductor cycle was in a major downturn, weighing heavily on the two largest components of the Korean index, while simultaneously the country's president had attempted a coup and been impeached. Political chaos layered on top of sector downturn, two overlapping sources of fear creating a price that had little to do with the long-term value of Korean exporters. Within approximately a year, that position was up roughly 1,000%. I trimmed twice in early 2026. That is not normal, but it is the kind of extreme result that occasionally emerges from a disciplined focus on fear-driven mispricing, patient position building, and the willingness to hold through continued short-term turbulence. Let me close by telling you what I think matters most from this entire decade of experience. Not the specific trades which are historical at this point, but the framework that generated them and continues to generate opportunities in the current market. Deep value investing is a counter-cyclical discipline. It performs worst during sustained bull markets when everything is going up and the crowd is being rewarded for buying popular things. It performs best during recoveries from fear-driven sell-offs when the crowd is selling things that will eventually recover. If you can tolerate the psychological discomfort of owning things that everyone else hates while they continue to underperform during the fear phase, and if you can maintain enough analytical rigor to distinguish genuine opportunities from value traps, you will find more asymmetric opportunities than the market can price into any given moment. The specific strategies I use, inverse VIX ETFs, leverage sector ETFs, contrarian macro positioning, are genuinely not suitable for every investor. The inverse VIX trade in particular requires deep understanding of how these instruments work mechanically, strict position sizing, discipline, and the psychological constitution to hold through 50% drawdowns without abandoning the thesis. The leveraged ETFs require understanding of compounding decay and the specific conditions under which leverage helps rather than hurts. These are not strategies to copy without that understanding, but the underlying principles: be greedy when others are fearful, be fearful when others are greedy, size positions to survive, being wrong. Never let any single investment become so large that it can permanently impair your portfolio. Pay attention to valuations throughout the holding period, not just at entry, and be honest with yourself when your thesis has been fully reflected in the price. These are principles that apply to every investor regardless of approach. The 25% position cap is perhaps the single most mechanically important rule I have. It forces selling near peaks and enables buying near troughs. It removes the emotional question of when to take profits on a winning position and replaces it with a systematic rule. It has cost me some upside in situations where my largest position continued to rise after I trimmed, and it has saved me from devastating losses in situations where my conviction was wrong or my timing was early. Over a decade of applying that rule consistently, the saves have far outweighed the opportunity cost, and that ultimately is the point. Beating the market over a decade is not about finding the next big winner every year. It is about building a process that generates more wins than losses, limits the damage of the losses, and keeps you in the game long enough for compounding to do its work. I have not always executed that process perfectly. The TNA mistake is the clearest evidence of that. But I have been honest with myself about the mistakes, extracted the lessons, and upgraded the process each time. That iterative improvement is what produced the cumulative result. If this video gave you something genuinely useful, a new Indedu Bello and in a new way, thinking about position sizing, a better understanding of what inverse VIX ETFs actually do and when they are appropriate, or simply a more honest picture of what active investing actually looks like in practice. Hit the like button and subscribe. I put serious time and effort into this channel because I believe the financial education most people receive is genuinely insufficient for managing their own wealth, and I want to change that for as many people as possible. Drop a comment below with the question this video raised for you, whether it is about inverse VIX mechanics, position sizing, or the deep value philosophy. I read every one and will try to address the best ones in future content. I will see you in the next one.